Of us on the East Coast, and those of you that are stretching west of us, it's probably still morning. Really glad that you joined us here at New View IRA and New View Trust in beautiful Longwood, Florida. This is one of my favorite subjects. Since founding the company about 20 years ago, I first got excited about self-directed IRAs and the subject when I was working in industry. And when I finished my job at Lockheed Missiles and Space Company 13 years ago, I rolled over that money. I found a bank that would be willing to hold my money. And my rolled over became an IRA, because you can roll over your employer plans to an IRA. And that's what I did. And my first investment was a piece of property in South Carolina. And I remember all my days that it was with Schwab, which it was with the employer plan, I'd look at the screen, and things were simpler back then. It was pre-Windows days, and I would look at my personal computer and see it red or green. And I knew my retirement was going up when it was green and red when it wasn't. That was when it was in traditional markets. And I said, I don't want to retire this way. I don't want this to be. So somewhere in my 30s, late 30s, I found self-directed IRAs. It's been legal to do this actually since IRAs were created in 1975. And I didn't want to be attached to anything else. 20 years ago, I took that knowledge that I used personally and turned it into a business called New View Trust now. So really exciting. It's exciting to talk about real estate because you can use your self-directed IRAs in lots of different ways. We're going to cover that the first half of this presentation. The second half is we're going to get into the meats and bones of real estate and how you can leverage. You know, and we have an audience here today, which is great. And there's going to be some questions coming from the audience, but you'll also be able to chat in your questions as you go. So you will be heard before we close up. You can always reach out to us here at New View Trust. Feel free to give us a call, and there'll be more information at the end of the presentation. But let's get started. If we can get our slides to move, which unfortunately we can't. I'm going to go ahead with this. If you could see if you could get Maggie in here. Would you do that? And we're going to go on with the presentation. Thankfully, I know a lot about this subject, so it may not come in order, but we're going to keep going on this until we can. We are not attorneys and CPAs. I'm not an attorney and CPA, although we have lots of clients that are, and certain our clients have CPAs and attorneys. But what you're going to hear today is really from 20 years of experience of having thousands of clients. So we come with very practical knowledge to share with you. However, each one of you has your own particular tax professional to go back to. So I'd suggest that anything we talk about, you share with them. And a lot of times what we find best is there's people out there that don't know about self-directed IRAs, and they may tell you no when it really means it's not no, it's I don't know. And those people, we ask you to just get on a conference call, bring them to us, and we'll explain what the rules are, point them to the proper sections of the code, and they become advocates. A lot of times become our clients. So we like to hear that. Oh, good, it's moving now. What is a self-directed IRA? Well, a self-directed IRA is actually something that you get to choose. Now, you could be with Charles Schwab, you get to choose, but the difference here on New View Trust platform is you get to choose everything the IRA does not prohibit. We're going to talk a few about those small things you can't do. It just opens up a wealth of opportunity. Unfortunately, the majority of US citizens, or at least those that hold IRAs and 401ks and 403bs, they don't want to make the choice. Flat out, they don't want to make the choice, even when they find out they can. So I always look at this business. I used to think it was for everybody. Everybody should go do this. But I realized not everybody's built the same way. They don't have the curiosity. They don't have the desire. They don't want to work to that point. We work pretty darn hard in getting our savings in place into these various vehicles. We ought to be willing to do a little work to get the results from them. Because if we're relying on third parties to do it, let's face it, there's lots of payments that have to be made, and there's lots of other people that stand between us and our money. And with a self-directed IRA or account, no one stands between you and the money. That's kind of cool. What are the benefits? Well, diversification. Now, we talk about that in the stock market, a little bit of the small caps, a little large caps. Maybe we're going to get something that pays dividends. Maybe what you do, you get placed into age-specific fund. So if you're 60 or 70, that may be very, very conservative stuff. If you're very young, maybe it's more aggressive type of investing. Yeah, but what about real estate? What about notes? What about mortgages? What about all these other things? Now, finally, you can be diversified. Tax savings are really cool. Don't forget why IRAs were created and then soon after 401ks. They were created so industry didn't have to pay their people pensions. That's basically why. A lot of people went to Congress in the 70s and said, a lot of industry leaders went to Congress and said, hey, we need relief. We need tax relief because we want to compete with the Japanese. It was the Japanese makers, not China, but Japan then, that was really cleaning the clock of a lot of American industries, especially the automotive industry. So he said, how can we be competitive? They don't pay the kind of pensions we have to pay. So half our profits are going to pay for people that have already retired and not adding anything to the bottom line for us. So let's say they lobby pretty hard. And that's where IRAs actually came from in 1975. It was basically moving it to you. No educational experience on how to invest, right? None of that was done. Basically what happened is they gave it to us and we now put money in. The employer puts a little bit of match in. And in an IRA, there's very little match put in. But in any case, that's how we learned how to invest. And we've had to learn it on our run. And now people my age, you can probably tell by the gray hair, we're having to learn it over our lifetime. Because when I started work in 1980, IRAs were 5 years old and 401ks were 4 years old. It was brand new. So over our lifetime, we've had to figure this out. People that are a lot younger understood their role going in. And maybe they're a little bit more investment aware than I was at that time. But tax savings are there, and they're only there because it was to get industry from having to fund your pension plan. And what I also love about it is I feel like I have a chance. I feel like I have a chance to pick investments, especially in real estate for me, and others of you may like another type of business or another type of investment. But I can't see what I'm doing in the stock market. I can just go by people that I trust. And sometimes you learn that you can't trust them. Just ask everybody that was going based on Jim Cramer's advice in 06 and 07 and see how well you did. It's remarkable that that gentleman's still on TV, but a lot of people follow him. And that's the problem. You have to follow people to learn how to invest. And it's much, much different in self-direction. So we're going to learn about some of those types of things. What are the plans? Well, there's personal plans. There's actually 4 types of IRAs. Everybody kind of has heard about the traditional IRA. That's the granddaddy. That's the one that's been since 1975. Roth IRAs came out about 15, 20 years later. Actually named for Senator Roth from Delaware, but he's not with us anymore. But in any case, what happened is people weren't putting enough money in IRAs. And Congress said, we got to stimulate this. We got to stimulate it. What about a Roth IRA? Well, what's that? Well, a Roth IRA means that you pay tax before you make the contribution into it. You go, well, what's the value of that? Well, the value of that is all of that can grow over the investment lifetime. And once you reach the age of 59 and a half, you get to take it all out at one time or continue taking it out, and there is no tax consequence coming out. Traditional one, you're going to have to pay tax when you pull it out. The Roth is not. And I would ask you to go to our library and you can learn the basics of IRAs. This is not why we're just kind of going through a hurry-up version of this to get to the subject, but you want to know a little bit deeper. I used to be completely agnostic about what type of IRA our clients have. Now I keep telling them Roth, 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 go Roth. We can hold any types of accounts, and all the investments we're talking about today, you can go do in a Roth or a traditional or a SEP or a simple, but why not a Roth? Because the last time you want to pay taxes, I'm told, is when you're no longer making any money as far as from your work goes on your investments. So imagine this, if you can retire and you have lots of different investments and you have a bucket of money in a Roth, all you need to take out of the Roth is what you need to spend. You don't need to go get another 20%, 25%, depending on your bracket, just so you can net out after taxes the amount you want. Another really cool thing about Roths is you're never mandatorily required to take a distribution in your lifetime. You can spend it, not spend it, it's up to you. You can leave it to your heirs. Now they'll have rules about how quickly they have to pull it out, but it's something that's sort of like that safety valve of money that you can set aside. So it's really cool. When we learn how we can invest it, Other types of IRAs is employer plans, and that's called a SEP, solo QRP. I'll explain what that is. A simple IRA and a Roth 401k. The 401k is your employer plans. You can certainly do that, but there's a special employer plan that we have for solo members. So, for example, if you're a realtor, for example, that's someone that's independent, it's not paid by an employer. You can actually fund your Roth IRA over $60,000 a year. This particular plan is amazing, but not everybody is eligible for it. You could also open up a SEP IRA. You can't quite put as much money into it. The simple IRA is interesting. That's for employers of up to 99 employees. And you can actually have an employer match plan. So it's like a 401k plan without all the administrative costs. There's zero administrative costs for that. So once again, if you're an employer of less than 99 people, that's good. If you're an employer of nobody or just a spouse or business owners, this solo QRP is for you. We house everything that has to do with tax-deferred monies in these plans here at NewView. So we're like a bank. When we try to describe to people what we do, we say we're like a bank. You put the money in the bank, and then you get to spend it in any legal way you can. That's the most tax advantaged that you can imagine. So we are not the company that says no. We're the company that says yes, 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 follow the rules. Yes, you can do it. It's kind of a nice feeling because most of the traditional houses such as Schwab and Ameritrade, and Ameritrade's not there anymore. Merrill Lynch, they're going to tell you no, you can't do it because you're going to have to invest in the stock market. You're going to invest in bonds, mutual funds, and probably they'll sell you a CD or two. That's all you're going to get. All right, specialty plans. There's a couple plans, health savings account. That's for anyone that has a high deductible health care plan. Believe it or not, you can stock away over $7,000 a year in this plan. It could be self-directed, just like your IRA. And if you have an IRA and an HSA, they can partner on one deal. Can you imagine this? So you've got this big bucket. You can have segments in the bucket of the different types of tax-deferred plans. And you can add your health savings account as a separate piece of the bucket, and it can own a percentage of what you own in your self-directed IRA account. Isn't that really cool? This is what you can do here. A Coverdale is you can save up to $2,000 for dependents. And this is not just for college. It can start at grade school, high school, college, and advanced degrees in college. You could also have your kids' education, your grandkids' educational plan, partner with your health savings plan, partner with your IRA. One investment can actually grow all the types of accounts. Really, really cool. What are the restrictions? Remember I said you can invest in anything the IRA does not prohibit. Well, there's people restrictions, there's transaction restrictions, and investment restrictions. Here's what they are. The people restrictions are these are people that can't benefit from your IRA or give a benefit for them. It's you. So in other words, what I'm not allowed to do is to go buy a piece of real estate at Ponce Inlet. I love Ponce Inlet. It's just a really good place. It's not a really good rental place. New Smyrna Beach in Central Florida is pretty good. It's very close to Orlando, Cocoa Beach. We have a lot of clients that are invested there. You can invest in a property. It doesn't matter where its location is. You can invest in it. Certainly the ocean is a nice place to go, but you can't stay it. Reason why is you're getting a personal benefit from your IRA. It doesn't matter what kind of benefit. It could be bed and breakfast benefit. It could be cash benefits. You're not allowed to do that. Second thing you're not allowed to do is give benefits to it. So for example, if that property on the water needs to get rehab, the kitchen's looking pretty old, or the roof collapses, whatever it is, the only way you can fix that up is with IRA money if it's owned by the IRA. You understand you can't put your personal money into it. You may need to go out and get a loan, and we're going to talk about what the loan process is. But I want you to understand that one of the people restrictions is yourself. It's going to be other people too, and let's see if there's a chart on that. Oh my goodness, look at all this stuff. I just want you to understand this. Generally, the problem is this. People want to do things with family members. Here's the family members that can't get a benefit from or give a benefit to an IRA. It's your spouse, it's your children and your grandchildren, your parents and your grandparents and their spouses. Geez, that's a pretty small area of the family tree. It's pretty much the trunk and all the spouses that grow out from the trunk. So it doesn't say anything about brothers and sisters, uncles and aunts, nieces and nephews. But as a practical person that runs one of these businesses called a self-directed IRA, I will tell you something, stay away from the family. Just stay away from the family. You're never going to really have an arm's length transaction. And the reason why the IRS puts all this stuff in play is you have to have an arm's length transaction. No special deals for family members. It'd be pretty easy for you to whisper or cut a deal at Thanksgiving about how I'm going to give your brother this, I'm going to give him a great loan out of your IRA, because you can lend your IRA, but should I lend my IRA to my brother? It's not prohibited. Yeah, but if you were going to get audited, the IRS would say, well, what's this loan to your brother at 2%? Now, would you lend your IRA out at 2%? Well, not in today's marketplace at all. You're obviously giving away a portion of your IRA. So understand, family members aren't good. It's also not there to help you fund your own business. That's helping you, right? So if you're the majority stockholder in a business and you're going to put your money into the business, now if you own a de minimis amount, that's a very small amount, it's possible you can do it. But once again, you don't have to live this life in the gray area of the law. You can live it in the bright sunshine, because there's so many advantages, so many things you get to do in a self-directed IRA. So I want you to be aware of the people's restrictions. What about the transactional? That you can't buy, sell, trade, loan, or extend services if you're one of those disqualified people that I talked about with your IRA, and you can't do it directly or indirectly. And let me tell you, in 20 years, I've heard every scheme possible. It's kind of like going to confession. Now, I'm not of the Catholic faith, but I understand a little bit about what confession is, right? It's basically telling people what you've done or feelings about what you're about to do. And usually, it's not about what people have done that they're trying to confess to me. They're just wanting to know, what are the things that I might do? And they're looking for some sort of absolution on telling you, well, that's okay. Well, first of all, I wouldn't try to presume on the IRS and what they're going to do in an audit from you. I have no idea. I know what the code says, and I know what the code doesn't say. And I will tell you something, just stay away from these types of things where it's going to benefit any disqualified party. Does that make sense? What do you think? Good?
Absolutely.
Absolutely makes sense. The investment, here's what it is. It's on a page, and you can go and look at this in the code, but it's a very small section of code that says, here's 2 things you can't invest in. 2 categories you can't invest in. You can't invest in collectibles. And they'll name those collectibles. Do you know that alcohol is named as something you're not allowed to put in your IRA? Well, there's a few people that are really, really important that know a lot about wine and fine for drinks and stuff. I think some people would be too anxious to take a distribution of that too, so I'm not sure. But they talk about rugs, they talk about collectible coins, they actually talk about precious metals, they talk about different things. There are exceptions to it. So for instance, this type of bullion is you can buy. You can buy silver and gold, and you can buy platinum and palladium. Those are the 4 types of metals that you're allowed. But what kind of metals? Well, you have to go in the code and do that. Our people, our investors do that all the time. We have thousands of investors. And believe me, everything that we're touching on today, they do. But some people, that's all they do. And some people in their self-directed IRA, they do 12 or 13 things. One of our clients, Greg, has probably 13 different types of investments. Generally, people stick to 1 or 2 that they might know. Life insurance contracts, this makes a whole lot of sense. When you think of life insurance, it's to benefit the beneficiaries of the life insurance. So if I was to buy a life insurance policy on myself in my IRA, what's the point? Because your IRA is to benefit you while you're alive, not while you're dead. And there's also a lot of chicanery that can go on, some things that can go on in this particular element that you don't want to invest in. And I say you don't want to invest in because it's very, very difficult to make money from this. And second of all, because you have to have complete trust in who you're dealing with. The second thing is, it says in the code you can't do it, okay? So enough about that. That's the investment restriction. What are the choices? So we're going to flip this on. This is the 99.9% that you can do, commercial property, almost any type of property in real estate. This represents about 50% of our clients. They do real estate of some type. It could be a group investment, it could be a syndication. It could be that one sort of crappiest house in their neighborhood that they picked up cheap and they want to rehab it with their IRA funds. You certainly can do that. Keep in mind that titling in this business is important. I want you to kind of understand the ownership structure. You own your IRA, there's no doubt about it. But the ownership is ownership as a beneficiary and a trustee. You kind of have two responsibilities. Beneficiary is it's yours, right? So you could take it out and spend it any way you like, subject to the IRS rules. You might have to pay taxes on it if you do it early, but it's undoubtedly yours. It's not mine. I'm the custodian of it. So I'm the guardian sort of within the bandwidth of the rules, as long as the clients do what they are supposed to do, which is to make legal choices. All right, it's not hard to figure out. We've touched on the main things that you need to worry about. All right, you're also the trustee. The trustee, typically in a trust, makes choices, right? Who makes the choices? Well, the custodian does it. We're passive. We do what you say you want us to do to keep all the tax advantages in place. Does that make sense? So that's what our role is. There's promissory notes that you can do. Oh, this promissory notes actually was, I'm going backwards. Let's go back. Oh man, I don't know what I've done here. Oh, I'm on the way to the back of the presentation. Yeah. So I'm going to go through some of the other subjects. Once again, I'm going to apologize for our presentation if you're dependent on the slides. So I appreciate it. We're going to get help on that for just a moment. Thank you, Maggie. Could you sit by? Yeah. Or is that perfectly? Okay, now we've got our expert in the room. Nothing else is going to happen. So we have private entities, trusts, joint ventures, limited partnerships. Understand one of the most attractive things in here, which I'm really surprised that more people don't do in their self-directed IRA or accounts, is joint ventures. Joint ventures I love because I may be the person with money, but I have no ideas. And people with ideas generally have no money. And so what a great team you could do. So I can actually have my IRA come into play. Let's say if I had a friend, Jim. I mean, it's possible I'd have a friend, Jim. If Jim has all the ideas in real estate and he's in it all the time and I'm busy working, but I've saved up a lot of money in my IRA and I have it to go not play with, but invest, but I love real estate. My trouble is I can't get out the door to see it. Jim sees it all the time. So Jim comes in, he's all excited, he's depositing some money in his IRA over here, and he sees me in the hall, and I'm using this as an example. I hope you understand I don't do this with clients, but if I did, I'd do it with Jim, all right? So Jim comes in, he's all excited because he found this very unique 9-unit apartment complex. And there's a lot of places like this in your town, cities where you are. They get built, they're not very big, they can get run down because people take the money and they don't invest in it. All of a sudden, they're ready to pass on. They're ready to sell it, and you have the neighbor that's got one of these. Tell them about coffee. They're talking about coffee. He said, I need some money. I'm going to go talk to Glenn. So he comes racing over here and he said, we can buy this. We can buy this. He's willing to lend money. In other words, he doesn't want to get paid all at one time. You know why? Because he doesn't want the tax bill all at one time. He wants payments over time. He's willing to finance this deal. Would you do it? Are you interested in doing it? I said, yeah, I am, but I don't want to manage it. I don't want to fix it up. I don't want to do it. Jim says, I'll do that. So we sit down with a piece of paper and we draw out what you're going to want from this venture and what I'm going to want from this venture and how long we're going to hold it. Are we going to flip it? Are we going to hold it? What's our deal? That is in a one-page document. We don't even have to get the lawyers invested in this. The more money that's on the table, you'd want to get a lawyer. But my point is I can have my IRA involved in that joint venture. I could provide part of the funding. I could provide other things necessary to get this done as long as I live within the rules. I don't understand why people don't do this. I think they just haven't seen the creativity of people doing it. It's amazing what you can do inside one of these accounts. And everybody always says, I don't have the money. Let me tell you, self-directed IRAs are a great way to go get the money. Either through the joint venture. We're going to talk a little bit once we get to this real subject of this on purchasing with a non-recourse loan. So Look at this, the clicker's working now. Thank you, Maggie. What's a non-recourse loan? Well, it's not the kind of loan you typically went to get for your mortgage. It's not the kind of loan that you borrowed to get your car. It's not the kind of loan that you would get from a local lender. Why is that? Any idea? Oh, there is a Jim in the audience, I believe. Any idea, Jim, why that is?
I haven't a clue.
No. Okay.
I mean, heard the word.
Well, the word itself, everybody kind of that's in the business knows what it means, but it doesn't really mean what it says. Recourse means if something happens, you've got a recourse, right? It means if something bad's going to happen, you have something that can help remedy the situation. Would you agree? And a mortgage is a recourse loan, typically, because what happens if you stop payment on your mortgage? Eventually, the house is gone, right? It's security. And there's lawyer fees, there's all sorts of fees. Typically, when you lose a house like that, there has to be a lot of equity in it, or else they're going to come back and say, Jim, you owe us the extra $15,000 that the house didn't get at auction, right? So in other words, you're going to have a residual bill. That's because it's full recourse to you, all right? This is not that type of loan. This, it says a loan normally secured by the property. So it's normally secured by the property. They can take your house. It's not additionally secured by the borrower's personal assets. I can't come after you. So understand, if your IRA takes on a loan, by the way, you're the trustee, right? And the beneficiary. Trustee makes all the choices. Beneficiary gets the benefits, right? So you're making a decision that I'd like to go get a loan and to buy that piece of property, maybe the one that you're talking about, right? The 9-unit apartment complex that we're talking about. I want to go do that. I want to do that with my IRA. Yes, you can do that. Yes, you can do that. There's a problem with it, though. Well, a couple things. First of all, understand that if you do that in your IRA, there's a taxable entity. It's going to create a tax liability for it. And we're going to talk a little bit about that in the example. Fair enough? So understand that you're going to do that. Also understand that the tax liability is not going to come into play unless you've made money on the deal. Taxes don't happen to people that don't make money. Taxes are the piece of what you make that goes back to the government. Fair enough? Okay. They haven't figured out how to tax us on stuff we haven't made yet, but they'll figure that out soon enough. And we'll be here to protect you against that as much as we're able to do. So understand that it's who's eligible? Here we go. The problem with it, the loan, is not so much the eligibility. All of us are eligible. It has to do with finding an institution or an individual that's willing to let your IRA lend to it. Because it's a non-recourse loan, the biggest protector of a loan generally is you and your credit rating. You know that if you don't pay back your mortgage, you're staying for the next, 7 years? I mean, basically, you're going to have to pay so much more every time you're going to go get a loan, or you're not even going to be able to get a loan. You know what it's going to do to your finances. So people don't want to do this, but what about their IRA? What happens if the fundamental thing that you're lending against, the property becomes worth in the toilet? Are you going to keep paying it with your IRA? What happens if you don't get enough rental income from the people in that unit to pay your IRA? What is going to happen? Well, that's higher risk, right, for the lender. That's why most banks and institutions won't do that. If they do it, they're going to require at least 30 to 40% down, right? In other words, that's equity. So in other words, that would have to all disappear before the bank's risk kicks in, right? So they want you to be able to do that. So expect, if you're going to borrow money with your IRA, you're going to have a big downstroke for the down payment, all right? And you're going to have to get a real estate appraisal, not just an acceptable real estate appraisal. They're going to want an appraisal of, you realize this, Maggie? They're going to want an appraisal of how much income can you get, what your rental's going to be. Because who's going to make the payments on this loan? The IRA. Not Jim, not Maggie, not Sue, not Bob, but their IRA. So that's the difference on eligibility. Everybody that has an IRA is eligible. It's the real challenge is finding an institution that'll do it.
Do you know any?
Pardon me?
Do you know any?
Somebody might know somebody, and you might hear that. So, and generally speaking, these are the types of, if an institution is actually gonna lend, it's gonna be in the 30 to 40% down range. It's actually the payments themselves, of what I've looked at, aren't that much more than any other investment property. It's primarily going to be down. This is very good business for the banks. It's just that most banks don't go outside of their normal lending. But some banks do. Processing, anywhere from 30 to 45 days. And that's really not us, it's really the loan application processes the bank. We just process the paperwork. Now, I think we have this in the presentation. We have a couple lenders, don't we? Okay. The terms are various, and you can get it from 3 to 5 years. Banks are scared to death of two things. They're scared to death that they don't get their money paid back, right? That's the chief thing. You know where the second risk is for a bank?
Done.
If they lend you for a long term and rates go up. Now they've given you money, and there's a lot of banks right there. There's a lot of people that hold mortgages in their own personal name. I know I hold a mortgage on a property that is 2.85%. It's kind of funny because that's what that's done is it's kind of locked me into something, right? I'm not going to give up that mortgage and sell that property because I'm going to sell property and get mortgages on it 6.5%, 7%, right? So I'm going to stay in it. That's interesting. But if I want to sell it, I kind of understand that I can be the lender now. It's kind of things have flipped, right? So banks are concerned about giving you 20 to 25 years. Typically, the investment, loan investments, the terms are usually 5 years, and then they get to restrike it or reprice it. Makes sense because they don't want to do that. And right now, it's kind of interesting in looking at the T-bills today, as we're doing the class today. They're basically saying that 5 and 10 years out, the rates will be lower than they are today. So the marketplace is predicting that. If they're right, I'm not sure. Here's a couple banks. We put the banks up here. Obviously, we're not connected to these banks. We don't get a benefit from these banks. I've met the presidents of both of these banks, as well as the people involved in the non-recourse lending. These are institutions that have been around a long time. The nice thing I like about these two institutions, they understand the rules. And so go to them for pricing. The first person you ever ask for pricing is the person that's selling the property. Because these banks, keep in mind, they have no skin in the game as far as what property you buy. But the seller has all sorts of reasons why they should become a banker. Once again, it may be they need to get the tax benefit back. So instead of getting paid the whole thing, they might get it over time, right? An installment sale is what that's called. You can be the beneficiary of that in your IRA, which is really, really cool. So think of the seller first. Other private individuals can lend to your IRA. I could lend to your IRA if I wasn't your custodian. But my point is, your friends and associates, why would they want to put their money into a bank and get 3.5% CD when they could go to you and you're probably willing to pay 5%, 6%? Whatever it is you guys negotiate. Can't be a sweetheart deal, but whatever you can say, I'll take whatever you're getting today and add 2 percentage points on it, and I want to borrow that. And I want to borrow for the next 5 years, 10 years. The fact is you can sit there and negotiate with somebody else's IRA. Isn't that cool? Now, they just need to be on our platform to be able to lend it to you. That's no problem. We have many, many customers who actually lend out to other people's IRAs. So there's 3 places you could to go. Think about the seller first, right? Think about other friends and associates that may have an IRA, and then go to these 2 institutions. And they may exactly be what you want, but I'd say be a little bit proactive and figure out what other people want. One of the audience members here talked about the type of investing that you're more drawn to at a particular time in your life. Now you look like you're somewhere in your 50s, right? Okay, maybe a little bit more, all right? But you do get drawn to things that are safe and secure, and we understand that. So people tend to lend money a lot as they get older. They do. Or they can go into annuities. You can go into a lot of bad things that don't pay you very much, but you can go into very informed things that will get much higher yield. And lending is one of those things. So don't forget, whenever you borrow money from other people's IRAs, you're doing them a favor because you're increasing their yield as you're able to get something done inside your IRA. So it's really cool what you can do. I'm going to briefly go through this. This is very high level. And the reason I'm leaving it high level is I don't want to lose the audience, because this isn't where you get into the firm details. I just want you to kind of understand, spark some interest, and then you can contact us if you want more details about this. I promised that I was going to create just a one-page summary of the way this is calculated. It's called unrelated debt financed income, and it's one of the things you have to pay tax on if you leverage your IRA. The concept is this. If you do a deal in real estate in your IRA, normally 100% of the money that you put in there has been either contributions through direct contribution or rollovers, right? And earnings on that. Would you agree? That's the way, two ways it gets fatter, and hopefully it gets fatter and fatter and fatter. What's not calculated in there is this idea that you can actually leverage it. So we know that probably the minimum down is 25%, but maybe it's 40, 50% down. The IRS has said this. The IRS said, I'm going to give you full reign to go have all the freedom that you can do inside all the types of investments. But that's an unfair advantage, meaning that's not what IRAs were created for. They were not created to be leveraged up. But the good news is I'm going to let you do it. But I'm going to be the beneficiary along with your IRA in this process, and I'm going to be the beneficiary by charging you a tax. Now, we kind of all laugh about taxes and that kind of thing, but they're there. And the whole reason people have IRAs is to stay away from that. But I want you to understand, as we go through examples, there's not a single example that I've looked at where the tax is charged if the value of whatever you're investing in goes up. You're not going to care that UDFI applies to it, because you're going to make more on doing the deal.
I gave him a little bit.
Yeah, and the reason you're making more is the fact that my friend Jim and I can actually go as partners on the deal. So imagine if Jim gets excited about this property, right? And let's say it's $500,000 to buy those 9 units. Now, I know what they're generating and all of that kind of stuff. It's a really good deal. Jim, my friend, brought that deal to me. So I got two ways that I can deal with Jim as a holder of funds. I can say, Jim, I'm in. I'm your partner. We'll each take 50%. Here's my 250. Where's your 250? It doesn't have to be an IRA, but it will be. That's fine. It doesn't really matter. So we go on at 50-50, and that means we split all the expenses. Everything that has to go into refurb this stuff has to come from our IRAs, right? Can't come from us personally, because we're disqualified people. And all the revenues flow in, and we cut them 50-50, and they drop into our account at New Year. Fair enough? But Jim said, I don't want to put $250,000 in it. I think the seller is going to help us finance it. So we only have to put 50% down. So Glenn, I don't need you. If I'm going to spend $250,000, I want 100% of this deal. You wouldn't come to me, right? Why would you come to me and give up half your deal for the same amount of money that you're going to put down? Like, why would you? The fact is that if you come with me and partner, yes, no unrelated debt financed income tax. Congratulations, but now you're giving up half your profits. The only thing you'd give up if you were borrowing is the cost of the loan, but you're flipping this anyway. So who cares? In a year, the loan's going to be paid off with the proceeds. So if you see that UDFI generally is not the reason you wouldn't do something. I just want people to know, as the owner of this company and as a practical person, should you leverage up your IRA? Ooh, that's a moral decision. But I'll tell you something, it's a business decision. You can decide. I'm not going to tell you my opinion. It doesn't really matter. It's up to you. It may be that's your only way of getting into this deal that's a winner. Why wouldn't you? If you're getting into a marginal deal and now you're putting your IRA at risk, why would you do it? Second little fact that I will tell you as a practical fact. If you're going to go do this, here's what I suggest. You open up a second IRA account with us. You're just going to have to pay an opening fee and an asset fee. I don't exactly know what that fee would be, $100, $200 difference. But what you're going to do is isolate that deal from all of your other IRAs. You understand what you're doing? And it's very good protection for them. because IRAs are tremendously protected by the courts. So I would just do that if you're going to do this deal. So under this term, it's going to be on the contract, and this is really key, and I don't think a lot of our clients, or at least our prospects, understand this. This is the key right here, this titling, that allows you to hold it with tax deferral. New View Trust Company, FBO, Jane Smith, Roth IRA number, all right? This is how you have to go into contract. This is how it has to be on every piece of paper, from the original offer all the way to the closing, the title policy. It's always that way. The reason why the custodian is named first, this stands for what? Any idea what FBO stands for?
For the benefit of.
For the benefit of. That is exactly stating there's a trust going on here. Here's the custodian, and here's the beneficiary of that trust. Remember, we talked about the role of the client is actually to be the trustee and the beneficiary, right? We're the custodian, that's what it states. And this is what keeps it legal, because we're a legal custodian. Loan terms, it's up to you. You're the IRA holder, the trustee, you get to decide what they are. And of course, you're going to try to drive it the rates as low and as beneficial to you, and you absolutely should do this. So in this case, they got a deal with the down payment of 25%. So of the $250,000 purchase price, $50,000 came from the IRA along with the repairs. So here's what people do. They get really excited. They got $50,000 in their IRA and they want to go do this deal. We say, well, is it going to need repair? Well, yeah, but I was going to kick that in. Is that allowed? No, you can't kick it in. Now, you can go borrow the money, but you can't kick it in yourself. You're not allowed to do that. So you need to make sure that your budget includes that. Also includes, you're borrowing money, you have to make payments, also include vacancies in that particular property. So I always suggest like an additional 20% for that type of thing. All right, now you can hold this for rent. The taxation still applies. But let's look at this deal. They sold it 18 months later for $275,000. Now, out of that, there'll likely be a cost to sell. Figure the cost to sell is about 8%. By the time you figure it, 3% for each side, broker fees and getting it ready and all that kind of stuff. So during those 18 months, they had profits. They had profits of the rental income, unrelated debt finance income, and the tax does apply. They did it for 18 months or 16 months at $1,800. Total rental income, $28,800. Now it's interesting, when you rent out something, you get to take depreciation, you get to take a lot of other expenses. So the taxes aren't based on the rental income, it's the net rental income. So two things happen here. This is going to have two tax cycles in it, right? Because it's 18 months, 6 months of the rental in the first year, and let's say they sold in December for the second year. So 12 months in December. So when they sold, there was a piece that is not subject to tax. Any idea why this $12,500 piece was not included in the taxable? Why is that not taxed?
Below the minimum.
Below the minimum. Not quite right.
It's what
Do you know?
have with the IRA.
This ties back to the down payment. Remember at the beginning, the purchase price was $200,000 and $50,000 came, right? So if you earned $50,000 from the net income, only 25% of that is not taxed because it was a gain based on the 25% that was not leveraged. Does that make sense? Mm-hmm. So these are the documents that I'm going to send you a white paper on to give you a more complete listing, because it's not all these round numbers, and I just don't want to lose you in explaining all of this. But I've taken a look at this deal, and the amount of returns on it is amazing. It's like 26%. Now, I want you to understand that most people would not do this deal. They wouldn't ask the seller, will you finance? They wouldn't go and ask the banks, will you finance it? And they certainly would not talk to their coffee friends on the weekend about it. Like, why not? The hardest thing to do in today's market is find a deal.
Oh, yeah.
I mean, and people tell us all the time, and we go to a countless at every weekend, we're doing 3 or 4 events with investors, and they're all scratching their heads. I can't figure this out. Well, let me tell you something. There's going to be, in the next 12 months, a big shift in our economy, in my opinion. Now, I'm not standing up here as an economist, but thankfully, I was in this business in 06 and 07. I saw what happening, and I'm starting to see that in a place in Florida that when I started the company here, there were 6 million less people in Florida than there are today. It's gone from 16 million to 24 million, or 22 million in the last 20 years that Nuvia's been around. It doesn't mean that times will always be good. Florida has a big history of ups and downs in their real estate. And although we're getting more jobs and more diversity, except just tourism jobs, things will hit us here. They're going to hit us wherever you live. And the fact is, if you have a self-directed IRA, you're going to be prepared for this. And you're going to find a whole lot of people that are willing to sell with seller financing that wouldn't dream of it today. So I want you to understand, we learned a little bit about the rules of IRAs today. We learned a little bit about the things that you can do, the breadth of them. But I wanted to waken people up to the concept of self-direction and taking on debt. For those of you that do this, and on my personal financing, I take on debt. I don't take a lot in my IRA, but I'm willing to do it. If that deal looks good enough, and I'm not risking my entire IRA if that deal goes bad. You understand? I think there's an element of risk in everything that you do, and I don't care if you're 99 years old, there ought to be an element that you say this is aggressive, but it becomes less and less of a portion of what you have, and everybody's financial situation is different. Some people are married, some people are going it alone in their retirement years. That's up to you. So what I want to do is just close briefly. Are there any questions? You can chat online. Are you able to see those, Maggie?
I am.
Are there any questions online that you have?
We do. We have 4 questions.
All right, let's give it a shot.
Question number 1,
And can you speak up really loud so we can hear?
Can a non-recourse loan be unsecured?
Can a non-recourse loan, can you borrow money unsecured?
Good luck.
It's interesting. I suppose you could, but here's the question. Why are people doing it? Because don't forget, it has to be an arm's length transaction. It would be very hard if the IRS was to audit this and take a look at it and say, why did they do that? But it's possible, because usually when you lend money, you want to know how that money is causing income to come into the IRA. Because the only way you have to add income to an IRA, it's either going to come from investments or creating it, or future contributions. And how can I guarantee that I'm going to be working or I have eligible contributions the next 2 or 3 years? So it is not disallowed. It's just a question of what's the basis of why they're doing it in the first place.
All right. Question number 2. Can a non-recourse loan affect credit score?
No, that's the beautiful thing. That's the beautiful thing, because don't forget that you are not signing. The only way your credit is binged or dinged or anything is the fact that you signed for the loan you didn't pay for it, or you paid for it slowly. No, it's detached from you as an individual.
All right. Question number 3. Do you need to have a guarantor for a non-recourse loan?
No, as a matter of fact, the only guarantor is the IRA and the underlying security instrument. So no, there is none.
All right. And last one, is it difficult to get approved for a non-recourse loan?
No. The answer is no, it's not difficult to get approved. What they're really going to look at is the property. They're going to look at the property a lot less than they're going to look at you. They're going to assume that if this goes bad, did I require the borrower to put enough down payment to go? So it's not a problem at all. They have the right, by the way, to look at your credit score. This is the irony. And I think they look at the credit score out of a history of who am I dealing with? Am I dealing with someone that's upstart? I don't think that there's no law that prohibits them from knowing everything there is about you. They're just not going to be able to hold you responsible for payment. It has to be the IRA itself.
Awesome. That's all we got.
Anyone else in the audience have any questions?
I can't think of one right now. Probably 100 when I hit the street.
I'm sorry?
I can't think of any right now, but probably 100 when I hit the street.
Well, good. Well, just like the audience then, here's how you can contact us. Just text us to leverage And by the way, if you want the white paper that I was talking about, please ask for the white paper. We'll get it to you as soon as I write it, which is probably in a couple days.
I want the white paper.
What?
I want the white paper.
Well, good. Here's all you have to do.
Text
Is
leverage.
simply text leverage to 407-305-0638. I want to thank you so much for your time. This has been a really exciting time to meet with all of you. I wish you could see everybody, but thanks for your questions. Thanks for your time. And please contact us for any questions on self-directed IRAs.